Hi friends, welcome to the channel JAIIB and CIB Made Simple. In this video, we are going to cover our unit number 6 of RBWM, and the chapter name is Product Development Process. So these are the topic which we are going to study in this particular chapter. So the topics are, as you can see, introduction, objective, then product development process, product life cycle, product line of bankers. Then we have deposit products or liability products, credit products or asset products, other product and services, other fee-based services, new product development, stages in new product development, constraint in new product development, product management, and product policy. So these are the 13 topics which we are going to discuss one by one. So this entire topic will be covered in 2 to 3 lectures. So this is our part 1 lecture. Let's get started. First of all, let's clear what is retail banking. So imagine a bank that deals directly with everyday people like you, me, shop owner, pensioner, homemaker, student. So basically common people. So imagine that there is a bank, right? And this bank deals with common people, right? Like a pensioner, homemaker, a student, basically common public. So such kind of bank is called retail bank, retail banking. Such kind of banking is what we call as retail banking. In simple word, we can say retail banking means giving different financial product to different type of customer through different channels. See, let me highlight the keyword. You are giving multiple financial product through multiple channel, right? Through different channel to different type of customer, through multiple customer segment. So multiple products, multiple channel, multiple customer segment, right? So that is what retail banking is all about. In simple word, we can say that retail banking means giving different financial product to different type of customer through different channel. So the bank offers some things like saving account, it offers saving account, it offers loan, it offers credit card, it offers insurance, right? So all these things bank offer, and these services are provided through what? These services are provided through branches, mobile app, and call center, right? Sometimes ATMs are also there, right? Mobile banking app are there, call centers are there, right? Call centers, branches, ATMs, mobile banking app. So you can think of retail banking as a supermarket of financial product for common people. Yes, you can think of them like supermarket of what? Of products. Supermarket of products for common people. So the easy formula to remember is retail banking is equal to product plus channel plus customer segment. One quick example I can give you: a bank that offer account, loan, credit card through its mobile app, website, and branch. That is called retail banking. Now the next concept we have: why do bank need innovation in retail banking? So the concept is need for innovation in retail banking. So customer expectation keep changing. People want faster service, better app, simple product, and more convenience. That is what people want. So bank must constantly upgrade, right? So bank must constantly upgrade the products. Bank constantly upgrade their products, their system, their processes. This continuous improvement is called innovation. So this continuous improvement, what we call them? We call them innovation. So innovation help bank grow, right? Why it help bank grow? Because innovation add better technology, it add unique product, right? It help add unique product, it help add personalized services, right? Customization, personalized services. So the growth formula is very simple. Growth in retail banking is equal to innovation plus process reengineering plus technology. Let me give you a quick example. For example, suppose a bank launching a mobile only saving account where you can open the account in just 5 minutes without visiting the branch. So that is an innovation. That is the growth in retail banking. So innovation means growth trigger, right? Growth trigger means you got innovation, process reengineering, technology, like a bank which is launching a mobile only search saving account where you can open the account in just 5 minutes without even visiting the branch. So master tip is that retail banking succeed only when customer interest stay above profit. So when the customer interest stay above profit, then only retail banking succeed. That is the key point to note. So that is the formula flashcard. Please understand. So as you can see that first thing that we have learned is that retail strategy means micro planning, plus pricing plus customization plus marketing, and competitive edge means technology plus efficient operation. So this is called 3M plus 3T rule. When I say 3M, that means multi-product, multi-channel and multi-customer, and 3T means technology, timeliness and trust. So that's called 3M plus 3T rule. Now let's apply the concept to some MCQs. First question: retail banking growth mainly depends on which key factor? High interest rate, technology and operational efficiency, limited product range, customer reduction. Yes, growth depends on technology and operational efficiency. Option number B is the correct answer. I told you now that better growth, better technology plus a smooth operation is equal to faster service plus lower cost. Next question: which of the following is not a part of retail banking? Corporate term loan, saving account, credit card, internet banking. So see, if we talk about the retail banking, this corporate term loan is not a part of retail banking. It is rather a corporate banking, right? So these are a big company. This comes under corporate banking, not retail banking. So that's why option number A is the correct one. Now let's have a look at the next concept that we have. So this way, we cover the entire syllabus of RBWM in the form of definition, key ideas, formula flashback, one line example, and then MCQs, right? So this is a very effective way to learn the thing, because the same thing gets repeated 2 to 3 times and it become completely memorizable in your memory. Now the question is, what is market segmentation in retail banking? What is the meaning of this market segmentation? See, imagine you run a bank. All the customers are different. Some are student, some are young professionals, some are family, some are senior citizen, right? Now if you try to sell one type of product to everyone, it will not work, right? So what I'm talking about, suppose that you run a bank, all the customers are different. Obviously some are students are there, young professionals are there, families are there, senior citizens are there. If you try to sell one type of product to everyone, it will not work. So bank divide customer into a smaller group based on common trait. It is the process of dividing retail banking customer into a smaller group based on what? Common trait. So common trait can be age, income, lifestyle, behavior, spending habit, etc. So this grouping process is called market segmentation. This is called market segmentation, right? So why bank do market segmentation? So basically the reason is because once customer are grouped, bank can offer exactly the right product to exactly the right people, right? So that is why market segmentation is essential. It is essential because once the customer are grouped, bank can offer right product. Bank can offer customized product, right product to exactly the right people. So this makes selling easier and keep customer happy. So the easy formula is, as you can see, segmentation means what? Segmentation means demographic plus psychographic plus behavioral plus income based grouping. One example I can give you, like suppose a bank create a young professional segment, right, and offer credit card with lifestyle reward like travel point, dining benefit. So this is a clear example of market segmentation. So in short, we can say, first of all, you segment, then target precisely, then sell smartly, and then retain longer. So that is called say market segmentation. Next concept we have is the data driven personalization. See, today bank collect lot of customer information: how much you spend, where you spend, how often you pay bill, your income flow, etc. So using this data, bank can understand what you need, right? Using this data, bank can understand what you need, when you need, what, when, how much, right? How much you can afford. So using this, using the data that the bank collect from lot of customer, the bank can understand what you need, how much you need, basically how much you can afford, when you need it. So this helps the bank to send timely personalized offer. So they can create timely personalized or customized offer. The idea is simple: give right product to the right customer at the right time, right offer to the right customer at the right time. These analytics help them. So the formula is that right customer plus right time plus right product is means higher conversion. One example I can give you, like suppose if a bank notice that you pay rent every month, it may send you a pre-approved home loan offer, because you might be ready to buy a house. So the master tip is that customer data must be used responsibly. Personalization should never compromise the privacy. This is a very, very important thing. So bank must use data with care. and transparency. Customer trust is more important than any sale. So the flashcard is effective segmentation. It means data collection plus analysis plus customer grouping plus targeted action. And revenue boost consists of personalized offer into correct timing. Right, these are the very important point. Now let's apply the concept to some MCQs. First question is market segmentation in retail banking help bank mainly in. How do market segmentation in retail banking help bank? So they help bank mainly in targeted marketing and better retention. Next question, which is not a common basis for segmentation in retail banking? Age, spending behavior, lifestyle, and now friends, let's talk about the types of market segmentation. Friends, if you are looking for such kind of a study material in the form of PDF, videos, mock test for the upcoming JAIIB examination in this format, you can check out our course on the app. App link is provided in the description section, or for more detail you can WhatsApp me on this particular number also. Now types of market segmentation. So once now we have understand that what is the role of market segmentation, why bank do market segmentation. Now not all customer are the same in retail banking, you know it very well. So bank try to understand the customer using some two types of data. One data is called qualitative trait, right? Using qualitative trait means these are the number based. Qualitative trait, these are the quantitative is number based, right? So like age, quantitative traits include age, it includes gender, right? It includes income and occupation and location. So these are the quantitative traits, right? These are easy to track and help identify who the customer is. In addition to that, we have some qualitative trait also. Qualitative trait like values, it includes values, interest, attitude, right, lifestyle and preferences. So these are called qualitative traits. So this help bank understand why a customer behave in a certain way. So quantitative, age, gender, income, occupation, location, and qualitative behavior and lifestyle based, right? So the smartest banking strategy uses both type of data together, right? So the maximum value you can get, you need to combine, you need to merge quantitative and qualitative data together. So that is the key idea. So I hope it is clear. Now the formula or rule is that effective segmentation, it means qualitative data plus quantitative data, you combine both of them, then we have the effective segmentation. One example I can give you, suppose a bank target high income digital savvy professional. So how they target? They use both income and lifestyle data to target the high income digital savvy professional, right? So basically in this particular case, this income data is quantitative, right? And this lifestyle data is qualitative. So this is how they target. So this makes sales easier and service more personalized. Now product development process in retail banking. Every banking product you see, like saving account, credit card, mobile app, home loan, it is not created randomly, right? Every banking product that you see, it is not created randomly. Bank follow a systematic process to build product that match the customer need. So systematic process is being followed by bank to build product that satisfy the customer need, right? So this process is called product development process. This is called product development process. So why this important? Because in retail banking, the product is the center of everything. This is the fulcrum of retail banking. Product is the center of everything, right? If product deliver values, customer stay. If it does not deliver value, customer switch. This is the very basic thing. Suppose there is a product, right, and it deliver the value. Product deliver value. So what happen? Customer stay. And suppose the product fails to deliver the value. If it does not deliver value, what happen? Customer switch, right? So a banking product has two parts. One is called tangible features. Tangible feature means something that you can see, something that you can touch, right? Something that you can see. To be more precise, it will be the correct definition. So tangible product can be tangible feature can be interest rate. You can see interest rate, number of free withdrawal, how many number of free withdrawal is there, cashback, suppose some bank give you, ATM access, tangible feature, mobile banking feature, tangible, while it has some intangible feature that you can feel only, like satisfaction, convenience, right, trust, comfort, speed of services. This you can feel only, right? So both tangible features and intangible features are there in the bank product. It is a combination of both the features. For example, suppose take the case of saving account. Now saving account is offering unlimited free ATM withdrawal. It is offering free ATM withdrawal, right? And in addition to that, right, we have a smooth digital banking experience. It is also offering is smooth digital banking experience. So basically this is a future. Free ATM withdrawal is a future, and digital convenience is a value. So this is a future plus value combo. That's what I told you now. Tangible future plus intangible values, right? Future, free ATM withdrawal, digital convenience, which is a value. So this combo increases the customer satisfaction. So the retail banking master tip is that a retail banking must evolve with customer need, right? A stagnant product is an ethical failure in customer service. Now formula flashcard. The first formula that we have seen is the value proposition. It means product feature plus add-on plus customer satisfaction. Product success, it means customer need match multiplied by continuous upgradation. You need to continuously upgrade. First of all, you see what is the customer need. Accordingly, you need to upgrade. So last point is tangible plus intangible. This create the values, right? Leverage the definition. Now friends, let's apply the concept to some MCQs. Bank derive maximum benefit from segmentation when they use only age data? No. Actually, they use both qualitative and quantitative data. Then only they can derive the maximum benefit from segmentation. Option B is correct. See, combining lifestyle, demographic, behavioral info, give deeper customer insight. Now, according to the Levitt, a product is only a physical item, only a service, a mix of tangible and intangible value satisfaction. And D is limited to features only. Just now we have talked about, according to the Levitt, a product is a mix of tangible and intangible value satisfaction. C number is correct. So as per Levitt, what does it say? That customer don't buy feature, they buy value. Customer always buy value. They don't want any feature. So value includes, emotional and service satisfaction, right? Feature is obviously there, but what they want, values. They are more focused on values, and values includes both emotional and service satisfaction. Emotional plus service satisfaction. That is the point. Now next concept that we have is the product life cycle. Let's talk about the PLC. In short, we can call it PLC. So every banking product, whether it is a saving account, credit card, or a mobile banking, it goes through a sales journey, right? So there is something called sales journey through which every banking product goes through, right? So basically this journey is called the product life cycle or PLC. So it shows how a product start, how it grow, how it reaches peak popularity, and finally when it become outdated. See, these are the process. Basically how it start, that's the introduction. How it grow, that is the growth. Then when it reaches the peak, that is the maturity. And then finally when it start become saturation or outdated. So the key idea is that each stage has a different level of sale. So we have just talked about the 4 stage. So this is a stage number 1. So it has different level of sale. This has different level of sale. It has different level of sale, right? So bank need a different strategy at each stage. Since sale level is different, so strategy is also different. So the formula is very simple: introduction, growth, maturity, saturation, or staleness. Let me give you a simple example. Suppose there is a new mobile banking feature, right? Feature first has low uses, then it become popular, then become stabilizes, and then finally become outdated. So a new mobile banking feature start with low use, grow fast, stabilizes, and then become outdated, right? So this is a clear example of introduction, growth, maturity, and then outdated. Now the next concept we have is the first 2 stage, introduction and growth stage. So this is where the product is launched. Product is launched, sales are very low, cost is very high, customer are not aware, right? So the bank has spent heavily on promotion. Here bank has spent heavily on promotion, right? So you think of this as a trial and error stage. You can think of it as trial and error stage. Next we have the growth stage. After introduction comes growth. So here the product start gaining acceptance, rapid acceptance, right? So what happened? Sales rises. Earlier sales was very low. Now the sales start increasing, right? Awareness also increases. Customer awareness also increase, and obviously cost decrease, right? Cost decrease, profit begin, and profit also begin. So the key idea is that basically bank usually reaches break even in the growth stage, not at the start, right? Break even happen typically in the growth stage. It does not happen at the start. For example, suppose there is a bank which launches a new digital saving account. Initially it costs a lot to promote, but as more customer join, sales increases. So introduces a new digital account. Initially cost is high, but as as the customer adopt it, as more customer join, sales increases. So these are the two initial stages, introduction and growth. The second, then third and fourth stages are the maturity and staleness. So maturity is the peak of the product, maximum sale, large customer base, higher profit, peak sale, wider customer base, maximum profit, a strong brand recognition. So this product is stable and successful. What about staleness and saturation? So after some time, customer interest begin to drop again. Competitor become competitor. So the formula is stagnation is equal to competition increases, high competition plus better alternative. For example, take the case of once popular credit card stop growing because other bank offer better reward or lower fee. So the master tip is that product must be refreshed before they turn stale. Customer deserve evolving values. So a bank must not let a product become outdated. Upgrading feature is part of the customer service. So the PLC formula flashcard is PLC path, four step I just told you: introduction, growth, maturity and saturation. And staleness means lack of innovation multiplied by high competition, right? Now let's apply the concept to some MCQs. In which PLC stage does the product typically achieve break even? Introduction, growth, maturity, saturation. Yes, it is called growth, right? Sales rises, customer acceptance increases in the growth stage. So helping, when I say break even means what? It recover the early launch cost, right? Break even means what? The sales is sufficient to recover the launch cost, product launch cost, right? Once it reaches that level, that's called break even, and it happened in the growth phase. Now the next question is, staleness in the product life cycle is mainly caused by zero competition, high initial cost, better alternative from competitor, increase in employee salary. Yes, staleness come because of better alternative from customer. C number is correct. Now let's talk about the declining stage of the product life cycle. Very, very important. Every banking product has a life journey: introduction, maturity, growth, maturity, and then comes the decline. So basically this is the final stage. This is the final phase where the product begin to lose appeal. What happened in the decline stage? So what happened? Customer loses interest. Customer stop using the product. Sales start falling. So customer start losing the product, right? Sales stop falling. Profit decreases, right? New and better alternative enter the market, and product feel outdated or irrelevant, right? So the key idea is that decline happen because customer loses interest, either due to market saturation or because competitor offers something better. That is why decline happen, right? Decline happen why? Because customer loses interest. You can see now they have written because the customer loses interest, either due to market saturation or because competitor offers something better, because of which decline happen. So the formula is very simple. As you can see, decline means what? Decline means drop in sale plus drop in profit plus reduce customer attractiveness. This is called the decline. Simple example I can give you. Suppose a bank is there. It closes an old saving product because hardly any customer are opening it anymore. So take the case of a bank which is withdrawing an old saving product due to low customer uptake. So this is the classic example of decline. Drop in sale, drop in profit, reduce customer attractiveness. That's called decline. Why it happened? Because customer loses interest, either due to market saturation or because competitor offers something better. Now the next concept we have is the revitalization and product fine tuning. Let's discuss what this is all about. So decline does not always mean the end. A smart bank try to revive or refresh the product before killing it. See, when I say decline, it does not mean the end. Actually, a smart bank try to revive or refresh the product before killing it. So this process of reviving or this process of refreshing the product is called revitalization. The process of value adding or modifying a product is called revitalization. Now what does the revitalization include? So it includes adding new feature. Suppose you are upgrading the feature, that's called adding new feature. You are repackaging, you are redesigning, right? You are adding some digital benefits, you are changing the pricing, you are changing the rewards. That's called revitalization. So the key idea is that a small improvement can bring the product back into stability or even bank back to maturity. So if you do the small tweaks, a small improvement, it brings the product back to stability or maturity. So this is the formula. Revitalization means future upgrade, repackaging, fresh marketing. For example, suppose a bank is there, it added the cashback or digital feature to a slow moving debit card to increase the customer interest. So that is a classic example of revitalization. So the master tip is that banks should aim to keep product in the maturity stage as long as possible to maximize continuous business and profit. So banks should aim to keep the product in maturity stage as long as possible to maximize continuous business and profit. That is the key point. So what is the formula flashcard? As you can see here, that PLC trend look like this: introduction, growth, maturity, decline. Second thing is decline prevention. How to prevent the decline? You revitalize the product, you reposition the product, you add the value. I grow, mature and decline. Now apply the concept to some MCQs. The decline stage of the product is characterized by rising profit, high customer attraction, falling sale, market monopoly. Here sale decreases. Right, customer interest drop in the decline stage. Why? Because of the saturation or better alternative available in the market. That's called decline. How can bank avoid product death during the decline stage? Stop the product immediately, increase price sharply, adding value and fine tuning the product exactly. If you add the value, if you fine tune the product, that's called revitalization. So through new features, updated marketing or repositioning, it helps extend the product life. So yes, product life can be increased. That's the point. Now product life cycle variation. So friends, now what we are discussing, we usually learn that every product goes through the 4 standard stages: introduction, growth, maturity and decline. This is what we usually learn, that every product goes through these standard stages. But in reality, not all products follow this ideal path. So in reality, what happened, not all products follow the ideal path. What happened actually, some product fall immediately after the launch. Some product die instantly. Some product are there which fail instantly after the launch. Some product, grow extremely fast and reaches maturity very quickly. And some product stays long in the maturity stage for many years. And some product, decline slowly or never fully decline. So these are the some product. Some fall immediately. Some grow extremely fast. Some stay in the maturity stage. Some decline slowly. So this variation happen because every product is influenced by research quality. Every product is influenced by research quality, marketing strategy, competition, changing trend. So the formula is that PLC path, research quality, customer perception, market strategy. For example, a poorly researched banking product fail right after the launch. If you have not done research properly, it will fail right after the launch. Next concept we have is regarding the product obsolescence. Right, product obsolescence. What does it say? It says that obsolescence means a product becoming outdated much faster than expected. Right, product becoming outdated. It become outdated much faster than expected. That's called obsolescence. This usually happen in industry where technology changes rapidly. So this premature product obsolescence, where it happen? It happen in those industry where technology changes rapidly. Even if the product is well designed and well researched, it may die early simply because something better comes out. So even well researched product can die early if technology changes rapidly. So the formula is that obsolescence means fast tech change. It leads to shorter product life. For example, suppose old model of computer or smartphone, they become outdated within month because a better version replaces them. This is the clear example of product obsolescence. So just now I told you, every product does not follow the same cycle. It's because of some reasons. I told you, some product fail immediately, some grow extremely fast, some may stay in the maturity stage for many years, some decline slowly, right? Now, the next concept we have is the core versus, augmented banking product. So banking product are of two types: core product, which is the basic essential services, right? When I say core product, these are the basic essential services. Please understand. So what are the things under core product? So it includes saving account, it includes current account, it includes term deposit, which is FD or which is RD. It includes RD also. So these are a stable, timeless deposit product. Customer need them regardless of the trend or technology. So these are the stable product. customer need them. That's called core product. The key idea is that core product stay long in the growth stage because they meet the basic essential need. So they stay long in the growth stage because they meet the basic customer need. So the formula is very simple, that core product is indispensable. So as you can see, they have mentioned, and augmented product are some value added product. So regarding the formula of core product, you can see essential, they are indispensable, and they have stable growth and long life. For example, suppose there is a saving account that remain stable even when the market trend change. So saving account remaining stable regardless of market trend, clear example of it. So the master tip is that core banking product do not require heavy marketing. They remain stable due to essential customer need. So core banking product, they never require heavy marketing. They remain stable due to the customer need. So people will always require saving account, current account. So this product naturally stays strong. So the formula flashcard is PLC speed. It means market research quality, customer perception, and packaging and repositioning. That is the PLC speed. And the core product longevity, it because of essential need and low marketing dependency. They don't depend on marketing because this is the basic essential requirement of every individual and the entity. Now, so what we discussed, that speed of PLC is means speed of the market change. It means faster the industry, shorter the product life. Now let's apply the concept to some MCQs. Which product is most likely to experience a very short product life cycle? So that is the question. Which product is most likely to experience a very short product life cycle? Saving account, term deposit, computer gadget, draft issuance. Correct answer is computer gadget. Why? Because take product become obsolete, of obsolescence because quickly due to the fast innovation cycle. Next question. Core banking product generally remain stable in which PLC stage? Core banking product remain generally stable in which PLC stage? Introduction, growth, decline, saturation. Correct answer is growth. Right. So core product like saving account, current account, FD, they remain in the growth stage for long because they satisfy essential continuous customer need. Then in addition to that, we have some augmented product. Let's talk about the augmented product now. So every banking product has a core part, which is the basic requirement, and an augmented product. So what we have discussed, every banking product has a core part, that is the basic requirement, and an augmented part, that is called, value added. That is called value added extra. So when bank add additional feature to make the core product more convenient and attractive, the result is an augmented product. So what bank has done, bank has added value enhancing feature to the core product. The product become augmented product. So what does augmentation mean? It simply means core product plus extra benefits. You can see now core product plus added benefits, right? So essential of example of extra benefit, let me give you some example like internet banking, like mobile banking, like insurance, like SMS alert, like cashback reward. So these are extra benefit. So the key idea is that as technology improve, feature that uses to be extra often become a standard. So earlier the feature that used to be extra now has become a standard because the technology has grown. For example, so what we have learned, that augmented product means core product plus added benefit plus customer convenience. For example, internet banking added to the saving account is an augmented benefit. Now let's look at the evolution of the augmented banking product. So banking feature changes over the time. When customer once consider a luxury become a basic need, right? So over the time, feature shift. Banking feature changes over the time. So what customer once consider a luxury, earlier, once it was considered luxury by a customer, now that same product, it has become the basic need. For example, a year ago, ATM card, debit card were a special add-on. They were considered a special add-on. But today, they are included in almost every saving account automatically. They have become the core product. Earlier, what was considered augmented product, now have become the core product. This shift happened because, technology is spread, customer expectation rises, and bank compete to often offer more values. So because of this reason, technological upgradation, feature migration from augmented to core, right? The key idea is that, with technology upgrade, feature move from augmented to the core. take upgrade, feature migration from augmented. One line example, like mobile banking once optional is now expected by default. Now present day core versus augmented structure. So in today's banking environment, the saving bank account has a clear structure. That is core SB component.